We're going to talk about AI chips, the boom, the bust, and the investment opportunity. Welcome back to Dean's List. We're going to dive into a major development in the AI world: the rapid rise and fall of AI chips like Nvidia's H100. Have you heard about the boom in AI over the last 2 years? If you haven't, probably living under a rock. You've probably heard about the demand for the chips powering this revolution. As of now, it seems like we're witnessing a GPU bubble burst in real time. Prices are plummeting for rental capacity. Question is, what does all of this mean for us investors? The AI chip boom and bust is fueled by the launch of ChatGPT in late 2022. What started as a rush for GPUs, the Nvidia H100 launched in 2023, was 3 times as powerful as its predecessor. AI startups were raising billions to get their hands on these chips over the last few years. And rental rates for those same GPUs went as high as $8 an hour just to get access. To give you some sense, $8 an hour makes it an extremely profitable venture. Fast forward today, and the H100 chips are now renting for less than $2 an hour. If you're an investor in a data center doing that, you're losing your money. It's a massive fall driven by an oversupply as new competitors and alternatives have come into play. Now, I know most of you guys and gals are not running out to buy AI chips. So, what does that mean for your portfolio? Nvidia. This is what we hear on CNBC and what everybody spends their time thinking about because it's got this gigantic gain over the last 3 to 5 years, right? Thousands of percent. Looks sexy. So it's skyrocketed, benefiting from this massive demand for cutting-edge chips. But now, with prices of H100s dropping, there's this glut in supply. And we want to know why and what does it mean long-term. It's important to remember that markets change. Just because prices have come down now does not mean there won't be another surge in demand. And, Nvidia's got a new Blackwell series of chips coming out. So OpenAI may create a whole new slate of demand for that. If the company can continue to innovate and stay ahead of the curve, there's a case to be made for their continued dominance. One thing to keep in mind, AI is not a static industry. We saw this massive surge in demand for GPUs in the last couple of years, and not just for training foundation models like GPT-4, but a lot of it is now used for fine-tuning the models, which is what's called inference. As the industry grows and more models are built and trained, the demand for GPUs could continue. Yes, we're seeing prices come down, but if the next breakthrough requires more compute power, demand could pick right back up. The real question is, with Nvidia representing, something like 6, 7, 8% probably of the S&P 500 index, can it keep innovating at the pace they have been to maintain the kind of returns that it's been producing for investors? Their lead over AMD and Intel has shrunk to some degree, and they're catching up with their own AI chips. So, can they keep launching products that their customers absolutely need? The answer is yes. Nvidia's got plenty of room to run. And yes, that specific business might be the best pick to benefit from AI. But don't forget the other opportunities that the shift is representing. There's AI software and infrastructure. So forget about the hardware-heavy plays. We can see what happens when chips go into oversupply. Look at companies that capitalize on AI growth without heavy capex. There are cloud providers. Oh yeah, we know them, Microsoft and Google. That's a way to play this, right? They're leveraging AI without having to directly own the infrastructure. There are also AI applications. Companies developing actual AI applications that have revenue-generating customers, such as Microsoft, their integration of AI into Office products. That could be where the real money is. It's all about value capture. The AI chip market is commoditized much faster than many expected. That doesn't mean it's a game over for Nvidia or the AI chip industry as a whole. Far from it. They got to quickly and effectively deploy compute power, and that's crucial, especially for the next generation of models, because they will need more power. Nvidia can keep launching chips that are better, faster, more efficient. They might see a rebound in rental rates, we don't know, and profitability. Another possibility is increasing the use of these chips for inference and not training. As the industry shifts to existing models and fine-tuning them, what I've read about is that fewer and fewer large AI developers are out there. And so most of them are focused on training existing models. Very few people can now break into this market to compete with folks like OpenAI, xAI, etc. Let's get to the bottom line. The rise and fall of the H100 rental market is a reminder that tech booms are often followed by busts. Doesn't mean we should write off Nvidia or the AI space entirely. That company remains one of the leaders in AI chip technology, and as long as AI continues to evolve, there will be demand for more powerful GPUs. But for our investments, the key takeaway is that while hardware might have its ups and downs, the need for innovation, compute power, and AI-driven software isn't going anywhere. If you believe in the future of AI, it could make sense to hold on to or even invest more into the companies driving that innovation. Just do so knowing the road ahead might be bumpy, and you've probably already got plenty of exposure to this space. Google, Apple, Nvidia, and Microsoft are all part of the major ETFs you likely own, whether it's QQQ for more technology exposure or SPY for the S&P 500. So congrats, you're set.